OPEC Plus resolved last week to extend the current oil output restrictions through the end of the year. Even though the statement came as no surprise, crude oil prices dropped significantly, leading some to speculate that the OPEC Plus cuts may already be triggering what is sometimes referred to as the cure for high oil prices, which is even higher prices. However, it's possible that oil still has further upward movement before it starts to influence demand. How high is the question, as it usually is? The answer is possibly a little higher. The oil minister of India issued a warning this week about unexpected implications of the OPEC Plus reduction, stating that while it was the producers' prerogative to choose how much oil they would pump, they should not be unmindful of the consequences. And it can become a self-fulfilling prophecy, that the demand will drop because people don't have the capacity to sustain it, Hardeep Singh Puri said. Julian Lee of Bloomberg claims that demand eradication is already in progress. The amount of gasoline consumed in the United States during this driving season was 600,000 BPD less than it typically was in 2019, the last year before the epidemic, with what is expected to be normal demand. Additionally, the most recent EIA inventory report revealed a significant increase in gasoline inventories, supporting the notion of a temperate demand for fuels. That build was, unsurprisingly, one of the aspects that affected prices this week. But even if demand may be declining in the US, it is increasing elsewhere in the world. Lee points out that the need for oil is increasing in China, India, and Brazil. He just claims that in order to counteract the losses in demand elsewhere, this expansion must be stronger. However, this would depend on the factors that lead to demand destruction. When it comes to US demand, prices were considerably below $90 per barrel during the summer driving season, therefore it wasn't prices that killed demand. Inflation, which is still high despite continually strong consumer expenditure, could be the cause. One of those years could have been the case. China's oil consumption is booming in the meantime. Goldman Sachs commodity experts recently noted the country's increasing need for copper, pushed by the low-carbon energy industry. China's demand for oil has been supported by record internal mobility, as indicated by robust congestion and domestic flight data, they added. Despite the government's worries about prices, India's oil demand is relatively strong due to the fact that more than 80% of the nation's oil needs are imported. India's oil minister stated this week that the nation will manage even if oil prices rise to $100 per barrel in spite of his warnings about price increases. Most people appear to anticipate that oil will move in this direction. The most recent to do so was Norway's Equinor, whose chief economist said, "I wouldn't exclude that we can see prices hitting $100 a barrel," but added, that wouldn't be because OPEC would wish it to reach there. They aren't aiming for that price, in my opinion. In fact, Eric Warnes brought up a very valid concern that has also been raised recently by others. Saudi Arabia, Russia, or OPEC Plus as a whole have no desire to see oil prices climb to unsustainable heights. They are knowledgeable about the type of treatment for increasing oil prices. This means that, as before, what they are doing is a delicate balancing act that can keep prices high enough for producers while also not destroying demand, at least not too much of it. The main question at hand is whether or not the world economy can continue to function even if oil prices increase to or perhaps over $100 without suffering a backlash that would ultimately result in much less demand for oil. For the time being, it appears like the economy is continuing to grow despite ongoing worries about interest rates, the recession, and consumer spending. Peak oil demand predictions are still coming in, the most recent coming from Rystad Energy. This week, the Norwegian energy consultancy surprised everyone by predicting that oil prices are set to decline significantly due to plentiful supply and a halt in the growth of oil consumption. This prediction conflicts with the chief economist of Equinor, who emphasized that constrained global production capacity was one of the reasons why oil may soon reach $100 per barrel. It also contradicts the underinvestment in new production that OPEC has been warning about for years, which would ultimately jeopardize the supply situation on a global scale. Despite the Saudi and Russian cuts, it seems like the market is now adequately supplied. However, the majority of analysts believe that the balance is precarious and that a deficit is just around the horizon. Once that is official, it will be evident if oil demand has been more elastic recently or, conversely, whether it has remained inelastic. And that might put an end to the peak oil demand discussion, at least temporarily. Despite the recent increase in crude oil prices, Saudi Arabia and Russia, the two main OPEC Plus partners, will maintain their oil production limits in November. Saudi Arabia announced early on Wednesday that it would continue reducing its crude oil production by an additional 1 million barrels per day, BPD, in November and December, and Russia said in a separate statement that it would continue to reduce oil exports by 300,000 BPD until the end of the year. These announcements came hours before a regular OPEC Plus panel meeting. Although some analysts have suggested that the kingdom may start easing the cut sooner than oil market participants believe, the world's top crude oil exporter would not risk demand destruction through too high prices. The market was unsurprised by the nearly simultaneous announcements from the two leaders of the OPEC+ alliance. According to the Saudi Ministry of Energy, which was reported by the official Saudi press agency, the kingdom's oil production will be roughly 9 million BPD through the end of the year if the further 1 million BPD decrease is maintained in November and December. This voluntary cut decision will be reviewed next month to consider deepening the cut or increasing production, the agency stated. At the same time, Russia's deputy prime minister and top oil official at OPEC+ meetings, Alexander Novak, declared in a public statement that Moscow will keep the 300,000 BPD reduction in oil shipments through the end of the year. Russia added that it would examine the choice after studying the market in the following month. Russia and Saudi Arabia both reaffirmed today that the ongoing restrictions to oil supply are intended to maintain stability and balance on the oil markets. The announcements were made just hours before the Joint Ministerial Monitoring Committee, JMMC, of OPEC+ met to discuss recent changes to the oil market. It was anticipated that throughout the conference, supply-related decisions would remain unchanged. After the AIA's most recent inventory report caused a sharp decline in both WTI and Brent, crude oil prices staged a tentative comeback early on Thursday. Due to a mix of profit-taking and economic worries, oil prices were already drifting lower at the beginning of the week, but news of weak gasoline demand in the United States appeared to pop the bullish bubble. The U.S. Energy Information Administration reported a rise in crude oil stocks but a significant increase in gasoline inventories in its most recent weekly petroleum report. Gas Buddy's Patrick DeHaan pointed out that the report's claim that the demand for gasoline had fallen to 8 million barrels per day was probably an underestimate. Oil prices fell to their lowest point in weeks as a result of the AIA report's sharp decline. The benchmarks are likely to record a significant loss this week unless they make a quick recovery later today. Just prior to the publication of the AIA report, OPEC+ said that it will continue to adhere to its production cap policy, which should have increased oil's potential for growth. The two main OPEC+ partners, Saudi Arabia and Russia, also said on Wednesday that they would maintain their voluntary production and export cutbacks in November and review the decisions the following month to see whether the cuts should be accelerated or slowed down. Rather than being a direct result of the demand for gasoline alone, the response of the oil markets to this news would indicate a wider underlying shift in opinion. There has been some discomfort for the bulls recently when the tailwinds were not as strong as previously because the 3-month increase in crude oil prices has been supported by the narrative of tighter supply dynamics and stable global economic conditions, IG analyst Yep Jun Rong told Reuters. Oil price increases could still occur in the fourth quarter due to deficit worries, but by 2024, recession worries may become more pressing and limit gains, according to Saxo Capital Markets analyst Karun Shanana. While the exact significance of this movement in sentiment is still to be determined, at the time of writing WTI was trading at $84.31 and Brent was up slightly at $85.89. What are your thoughts on OPEC+ and Saudi Arabia, and do you think they can collapse the US economy? Let me know down below. If you want to continue to learn about business investing and financial education, we have got this video waiting on the screen for you to check out. Don't forget to give this video a like and subscribe for more videos like this. Thank you so much for watching and I'll see you in the next one.